Fed has their meeting next week, and bets on the market is they're going to increase rates again. Good morning, Brendan Rendo with the Homes Orlando team, and joined again with Joseph Dion. Missed you last week. Hope you're doing well.
Doing okay. Wait, I kind of want to just duck and get out of here though. Like we're talking about Feds now and the meeting for next week. I don't know if I want to be a part.
Yeah, we got it. It's coming up May 2nd and 3rd.
Yep.
And people are looking on the street right now, and betting people are betting, hey, they're gonna increase rates again. And I'm just wondering, are they pushing it too far?
Yeah. I think and all like betting, everybody's saying it's going to go up, right? Like I think there's like, the pundits and everybody are saying like maybe a 14% chance it doesn't go up. So 86% saying we're going to see something. I feel like we're seeing a lot of cracks right now.
Yeah.
The Feds are like, you know what? Let's make them bigger.
Yeah. Yeah. I mean, I was going through and looking at some of the news on the unemployment numbers, and it really, whoops, sorry about that. There's more than I even realized.
Mm-hmm.
This is just looking at April unemployment numbers. We know we went through the revisions, and we had from January, we were revised up about 300,000 roughly.
Mm-hmm.
The number of unemployed went up, but right now we've got announced by Tyson, they're going to be laying off nearly 1,700 employees. You got 3M, who just announced they're laying off 6,000 around the world. I mean, they're a huge manufacturer. Lyft's going to continue to do some huge reductions. They had already laid off 13% of their workforce back in November. You got Whole Foods going to be doing some layoffs. How do you pronounce this one again?
I think it's Deloitte. I think that's what.
Okay, consulting firm. They're laying off 1,200 employees. BuzzFeed, they're doing a 15% reduction. They've actually done away. What was it? BuzzFeed News is gone.
It's gone. They axe that division.
Yep. And this, I had no idea there were this many people at David's Bridal.
9,200. Like, is that like 90% of their workforce?
I have no idea. I have no idea they had that many.
I didn't realize there's that big of a company.
I didn't. I had no idea. So there's roughly another 10,000, and then Walmart is laying off 2,000 in their fulfillment centers, which is like Amazon, where you place an online order and they fulfill it. That tells you that consumers are pulling back on their spending, which we've seen quite a bit of. But they're also cutting within the retail as well. They're cutting 1,000 jobs in Texas, 600 in Pennsylvania, 400 in Florida, 200 in New Jersey. Then we got, of course, McDonald's. They're going to be laying off some people, and Bed Bath & Beyond has gone under.
Hey, Bed Bath & Beyond, they're a rock. They've been around. Like, how they're still around, I don't know.
I don't know how they did it. I don't know how they lasted.
Maybe the final one for them. Yeah, like it's interesting. And what's you kind of hit on this too, is like there's a website called, I think it's like layoffs.fyi. Mm-hmm. Which is a live tech industry tracker for layoffs in the nation.
Okay.
That like rolls out, and it's like, I think in the tech industry, and the reason why I say this is what tech industry is typically what?
Higher paying
jobs. But there's been 184,101 layoffs reported to this site from the companies. And they're like, I'm on the list, and I'm like, all right, 300 on the 26th, 400 from another company on the 25th. Number that don't report how many, but one company, but this is worldwide and US. Mm-hmm. So sometimes, it's like we're seeing a lot of, like, those are the areas where I'm like, oh, that paints, because when tech companies, right, and they've all been in growth mode, now mm-hmm. they're all compressing.
Yep.
Like, well, what does that say?
You had Silicon Valley, which was a big underwriter mm-hmm. of a lot of these. Of course, them going under not that dries up their incubation money overall. And then, of course, we've seen everything going on with First Republic, and
First Republic.
Whoops.
Teasing us with that
one. Boy, have they taken a hit this week. Oh, my God.
Let's just zoom into the one day and let's look at that positive gain, because that looks way better than the week.
There you go.
There we go. One day looks way better. No.
Yeah. From 575. Whoa, yeah. Today you're doing great. But don't go back 5 days. That's the whole thing.
5 days.
They lost 49% in one day in value. Then they lost 25% more of it the next day.
Mm-hmm.
And I was interesting because I was listening to a gentleman I listen to on a regular basis, and what they're trying to do with their loan packages is, because you're a nice guy, Joe. I know you're a super nice guy, and you're willing to buy these loan packages worth $100 billion at a premium and get a warrant for maybe some stock down the road, right?
Like, oh man,
come on, Joe. Come on.
Like, are we really like, hey, like you're gonna pay a premium, and for people that are watching that don't know, a warrant is basically, we're gonna give you the benefit of allowing to purchase our stock at a certain price point sometime in the future within. So like, it's like, hey, if our stock recovers and we make it through and we end up positive, like, it could be worth something. But if we don't, like, it's worthless.
Yeah. It is completely worthless. And I don't know how they fended off the FDIC coming in and taking them under receivership yet. But gut feeling is probably by Friday, if not during the meeting or before the meeting. That would be very interesting if that happened.
That would be that could change.
That could yeah. What do you do if on May 2nd, which is what, Tuesday?
Yeah.
You start out your meeting and you get interrupted because you have to go save First Republic.
I don't know. And First Republic has what? I think they have, I was looking it up. They've got, it looks like 289.5 billion in assets.
Mm-hmm. Somewhere in that ballpark.
So that would be Fed's got to, I feel like why do I feel like this is one of those things where the Feds aren't going to do anything? They're going to sit there and increase rates, and then the day after they meet, they're going to take servicing. I just feel like something like that's going to happen.
Yeah,
like, it won't play out the other way. It'll play out this way.
It's just you're just sitting there and you're just going, come on, guys. You know what? There's everything that they've wanted to happen to slow down the economy is happening. So why are you going to continue to put additional stress on it?
Mm-hmm.
We know what's caused a lot of the bank problems, which is the big increase in the interest rates and the banks losing money between what they're servicing on their current loan packages and current interest rates. So you're just going to continue to put additional stress on it, and at this point, you're accomplishing what you wanted to accomplish. Unemployment's definitely going up.
Mm-hmm.
We're seeing some headlines in the news about foreclosures increasing. So you're achieving what you want. You're not going to hurt. I don't think you're going to hurt anyone by pausing. And I think with the consumer buy pullback, I think you're going to see the unemployment number, or not the unemployment, but the inflation numbers continue to push down.
Yeah.
So let's, the simple economics, less demand, you got to lower your prices. Right. So it's going to be interesting. I'm thinking a quarter. I hope they don't do a half. I really hope they don't do a half.
I can't see them doing a half. I feel like a half would be like, I just feel like they're going to push a quarter, like you said, but if they do a half, it's going to be like, ooh, I just think it's going to create too much.
Mm-hmm.
And I think that they would look at it and go, that might be too big. Like
Yeah.
they realize that, okay, we want to inflict a little more pain, but we don't want to, we don't want to do a death blow.
Yeah.
We don't want to do something that's going to have massive. But it's going to be really interesting to see how these next couple of days play out, because, we've got all the reports are coming in and they're kind of mixed all over the place, some are good, some are bad. The ones that are good, I'm like, they'll revise to be worse by middle of next month. That's usually how it works.
Yeah.
Right now. But I think that's kind of the area where it's like, okay, I would, like you said, I would prefer to see the Fed say, hey, let's pause and let's let this play out for another month or two and see do we see the actions happening at the, but I just don't know if they're going to do that. And that's the hard part.
Yep. Yeah, it is. So it's just one of those kind of sit and wait situations. And of course, we'll see. We'll see. Well, let's look at how Orlando's doing overall.
Woo!
So consistent. We are just consistent overall, and it's nice. We're not totally crazy, and we're not no one doing anything.
Yeah.
So it's consistently in that 400, a little above 400 level on our sales. The median sales price, holding pretty steady at that 400,000, which, man, we have just been consistent there for the longest time.
Yeah.
And unfortunately, we did take another drop in the inventory.
That inventory, that's the one concern. We're not seeing inventory, that bump, right? Like, which I really would like to see that, because that's going to help. But I think, we're going to see, like, we're scaling back to a seller's market.
I think until, I hate to say it, until we start seeing some of those foreclosures starting to hit, Disney's doing some layoffs. They're doing some big layoffs. So if we start seeing that number of foreclosures increase, I think that will help put it up. But the other thing is, I was reading an interesting article that one economist felt that until we get down to about 5.5%, that a lot of people who have the lower interest rates and are locked in at those lower interest rates just aren't gonna do anything unless they have to.
Yeah, that makes sense.
The past couple listings I have a listing coming up here next week, and it's a have to situation. I don't want to, but the past several have all been I need to sell. Two of them, and I think we're going to see a lot more of this, are the baby boomers who have just hit that point where I need to downsize. The cost of maintaining this 2,000, 3,000 square foot house, with the association, the taxes, and everything, it's just gotten too much. I'm starting my retirement. I don't need anything this big. I'm going. I want to scale down, and I've had more inquiries for two bath homes lately than I have for the 3 and 4 bedroom homes.
Yeah,
which is kind of interesting. It's like, And then I got one client looking at a couple different 55 plus communities, and the new ones, no discount. They're selling as fast as they're releasing them.
Wow.
So it kind of shows you where the boomers are headed. Downsize it.
Florida, retirement land.
Retirement land. Yeah, the one she's looking at, she said there's going to be like 900 homes in it, something like that. And they're all the villa style homes and everything. And they've got a waiting list of like 30 people because the builders are going to release it slow so they can keep the prices up. So it's just kind of it was eye opening for me to have the conversation with her.
Yeah.
So then we get into our price differences,
Yep.
original list and final list price, again, consistent, holding right there, the 95, 98%. And in the market that, you and I do a lot of work in, again, is that, $400,000 to $500,000 market. And, you're only getting about 1% off right now. And that's due to the inventory.
Yeah.
And you see, the overall market average is 52 days, but in this price range, it's 41. It's a lot less, because that right now is the bread and butter of the market.
Yeah.
And with so few available, I mean, when you go on my website and I do a search for people, easily 1/3 of the searches are new construction homes that the builders have put on, which they weren't doing a couple of years ago. Then this is, our sales graphs, sales price again. I mean, look at this. I mean, you can almost draw a straight line right there. And then our sales still holding steady. We're holding above that median line of about 400 units, which is nice to see.
Yeah, absolutely.
Yeah. We did take a little jump in the overall average days on market. And then this, I was hoping we hit the spring, and it's like, we flatlined. We're gonna take it. Nope.
So
80 doesn't seem like a lot, but it's that slow drip of inventory just whittling away.
Yeah, and that's the key. Like you said, it's not like we're not seeing new inventory hit. Like, and now it's like, I think you showed on one of the others, it says like months of inventory, and it was like everything was under 2 months of inventory, except for your $1 million+ homes.
Yep.
But I was like, like everything else, 1.2, 1.5, 1.7, like months of inventory. Like, that's not a lot. I mean, I mean, on a real estate side, what is it? 6 months of inventory is kind of a neutral market, right? So, like, at less than 2, we're definitely seller side. We're not having what we had before, and I think it's because the buyer pool is a lot smaller as well, right? Like, so you don't have as much bidding, but it's definitely skewed very strong to the seller. And I think, but even though it's limited inventory, buyers still have that wiggle room to negotiate because sellers know, I don't have a bunch of options behind you.
Yeah, exactly. Here's an interesting question we got from Deepak. He's asking, any comments on how the non-QM subprime lending would play out in these higher rates, as lots of buyers are not qualifying for traditional loan programs?
So how the non-QM subprime will play out with these rates and such?
Yeah.
I mean, the hard part is with that, they're not going to play out for the traditional, those loans, that marketplace. And we have a community product that the borrower for a primary or second home can do no income verification.
Okay.
Like, you don't see much. Like, I say that, people are like, what does that mean? Is that 2005, 6? Well, the difference is like, you want to do that product, you're putting 25, 30, 40% down to get the best terms. So, in those situations, I think you might see a little bit, but I don't think you're going to see a lot more of that in that non-QM, that marketplace. Those are just large down, like, it's 15 years ago, they didn't put, you can get those products with minimal down.
Yeah. Remember,
sometimes you can get money in your pocket with those products.
Yeah.
While buying the home. You can't do that anymore. And we are seeing across the board, we're seeing tightening. And we've seen tightening for a while. And the problem is because we don't know where rates are. And those type of price points, they're great. But what I have seen on a lot of those is I've seen a lot of prepayment penalties that kind of lock people in to those products to make sure that they're not getting in and then getting out real quickly.
Yeah. The lender's got to make his yield to make it profitable for him to actually originate the loans.
Yeah.
Then just go over our condo market, and again, consistent. They actually sold the exact same number last week as this week, 143. You don't see that very often. So overall, Orlando's we are just chugging along and being consistent. I think until Fed's saying we're going to have a recession. Recession usually means lower rates overall.
Yeah.
But the difficulty is you got lower rates, but less people employed.
Yeah, it's a double-edged sword, right?
Yeah.
Yeah.
And I mean, it may help out your refi business, which I know is almost, my gosh, pretty much non-existent.
People refi because they have to, like you said, they're getting divorced, they're getting separated, they got to buy someone out, they've got this, or they're, and then we do see a lot of home equity loans, like taking advantage of that increase in value to do different things. But we are seeing people pull back a little bit on that too, because there is some uncertainty. So they're not wanting to kind of increase that liability, that monthly payment for their housing with that uncertainty in, kind of where the economy as a whole is going.
Yeah.
So it's definitely been very, very interesting. I will say on that non-QM to traditional, the spread between those type of loans, they're a lot smaller now. So, it used to be like, when rates were in the 3s, like non-QM was like in the 7, right? Like now it's like, okay, if rates are in the 6s, non-QM is in the 8s. Like, it's not as bad to be like, you know what, maybe I'll look at that option. Like, I'm not just going to throw it out the window.
Yeah.
Because they look at that traditional payment and they go, oh my gosh, that's more, it's not as big of a punch to the face when they see that non-QM rate, because they see, well, everybody else is over here. You're already at high rates too. So we have seen an uptick because of that aspect.
Gotcha. Well, I appreciate your time this morning. Thank you everyone for joining us. We'll see you again next week, and we'll see if we're both right on that 0.25%.
We'll see.
Take care. Have a
guys.
wonderful day. Bye-bye.